there, everybody. Welcome. It is time to get started, and thank you for being with us right on time today. We have traders attending this webinar from all around the world, and wherever you are, I hope that you're having a good weekend. We do remember and realize that these are tough times for many people, and we hope you and your family are staying safe and well. This is Craig at Max Trading. Chris and Eusebio are here as well, and we're just glad to include you in the Max community for today. Other traders will join us later by video. We welcome you also. You know, we jokingly say that the sun never sets on the Max kingdom, but actually that's the truth. We do have members in every corner of the world, and it's such a privilege for us to be a part of a vibrant and active trading community. The COVID virus has made life rather difficult for many of us, maybe all of us, but I do love it that trading can be done safely within your own home, and perhaps that makes this an ideal time for you to learn a very profitable trading system. And we love having the opportunity today to show it to you. And on top of that, Eusebio is teaching today, sharing with you 3 important trading tips. So we expect this to be a very beneficial webinar for all of us. It's a truly exciting time for Max because we are intimately acquainted with the Max trading system now. We've been trading it for more than 12 years. We know with certainty that it is a game changer for all skill levels of traders. Newbies to proven veterans, everybody loves the confidence and the success that comes with this system. More than 2,000 traders have graduated from a Max trading course. That's a lot of training, folks. We have learned how to do it extremely well, and you will get the help that you need and more. In fact, on the 11th of February, we begin our 72nd Max Standard course, our flagship course, where you can learn a very profitable, very flexible trading system, excellent for all markets and all time frames. So what does that mean? It means if you like the excitement of fast charts, let's say 1 to 5 minute time frames, you will love trading the Max system. Or if you perform better on a somewhat slower chart, perhaps 15 minutes or 30 minutes, Max is for you. And if you do not have a lot of time for trading, or you just don't like sitting in front of your charts for hours at a time, you'll love the Max as well, and you'll be very appreciative of the longer time frames, maybe 4 hours or 8 hours or daily. So Max is perfect for you. I recently helped one of our members set up 12-hour time frame charts, and he is very excited about trading that longer time frame. And if you prefer markets such as the YM, the ES, or maybe DAX, or Forex pairs, or commodities, options, stocks, Max is also for you. Very flexible, very powerful. And with Max, you also get this great trading community. Many of you will be taking a Max course with us in less than 2 weeks now, and that comes with your lifetime Max membership. So we look forward to being with you for many years. And not only is the Max community fun and providing a lot of camaraderie, and I think that's important, but it also provides a wealth of ongoing support and never-ending assistance, along with complimentary trading workshops, at least 2 or 3 every single month all year long, which allows you to continue building and improving your skills as a trader. Very important. New ideas really are necessary these days in trading. The markets are in a state of flux. The changes come rapidly, and that's a challenge. Eusebio has helped us to meet that challenge by developing a solution which we call the Max Enhanced Trade Format Indicator. And I know that's such a mouthful. We just call it the ETF, Enhanced Trade Format. It has proven itself a very effective addition to Max Trading, and I know you're going to love it. and you get that indicator along with the companion, all at no additional expense. It comes with your Max training. And by the way, we are in the process of dropping the ETF name, not from the indicator, but from our system names. It just has simply become too confusing, with some traders thinking we trade only the ETF market and not realizing it only refers to this particular indicator. And the companion is our price direction bias indicator. It can make a huge difference in your trading results. And you wrap all of these things together, the professional training, correct price action analysis, knowledgeable global context, a supportive trading community, a lifetime of assistance from your coaches. All these things together give you the perfect opportunity to learn trading that actually makes a difference in your life. And no, we do not expect you to just take our word for it. We know that's difficult. So we want you to see for yourself. I will be sending you an invitation to attend a live trading webinar scheduled for this Friday, where we will trade the price action resulting from the non-farm payroll announcement. So you will get to see on real-time charts the effectiveness of the trading system. And the great thing about this is, you know, on live charts, you can't exaggerate and you can't hide anything. Everything is right there out in the open for all of us to see. So I hope you can attend, and if not attend, you should register anyway. Get registered, and that'll put you on the video list, and we'll make sure that you get to see the video playback of the live trading. So thank you again for attending today. If you have questions, please ask anytime. Eusebio is the developer of the Enhanced Trade Format Indicator along with the companion, and he has traded himself the Max system full-time for many years now. And we'll get him to tell us a little more about his background, but I can assure you he is absolutely the perfect choice to give us the details about the Max trading system today. And not only is he a phenomenal trader, he's also a very skilled teacher, and I really like it that he gets genuine satisfaction from helping his fellow traders. Eusebio, thank you so much. We're grateful for all that you do, and also for your time today in showing us the Max, and I'll hand the microphone to you.
Thank you very much, Craig, for this introduction. So welcome everyone to this presentation of the Max trading system. Let me give you just a few words about who I am. What is my background, as Craig has said. I am, in fact, a former software engineer, and I have exercised that profession for around 30 years. And the last 15 years of that profession, so I have had the privilege to work with important banks and exclusively with banks in Europe. And I have been in that way in contact, and I have learned a lot from banks traders. And this is why a very important concept we teach in the Max so are justified by the way that they are related to how the big boys, I call them the big boys, are working, are operating in the market. But in parallel to my professional career, I have always been interested in the investment and trading activities. And I have now a 38-year experience in many markets, the Forex market, of course, the futures market, the stock market, the options market. When you trade stock, you can consider to trade options on optionable stocks, of course. And I have always been, until 2008, a part-time trader. But since 2008, I became a full-time trader when I stopped my IT services career. And in 2009, I have had the privilege to become a Max instructor after its creator, Dr. Jim Pruitt, passed away, so a few months before. But I am especially now interested in Forex, and I trade the Forex since 2000, in fact, so part-time until 2008 and full-time since 2008. And so what I'm going to present you today is some of the concepts of the Max trading system. We have called the new version of the Max the ETF Max, but I will drop the ETF acronym to make it simpler. So if you don't know what the MAX is, let me tell you that the MAX trading system is very perfect for everyone who wants to trade in the market. If you are an experienced trader looking for consistency in their trading process, but also in the way to generate profit, then the MAX is certainly for you. If you are a full-time trader and you want to multiply your profit, to increase your profit, and I will show you how to increase your profit with the MAX, then the MAX is for you. On the contrary, on the other side of the range of trader, if you are a newbie needing a reliable trading method, or if you are still struggling becoming profitable, then the MAX is certainly for you too. But this requires some investment, in fact. If you want to work from home, and today is a very ideal period, if I could say that, due to the pandemic situation, many people are forced to stay home, many people are forced to work from home, and so trading is a special kind of job you can practice from anywhere. You just need to have a PC and an internet connection, so working from home is just an ideal situation to trade the markets. If you want to plan for your retirement, if you want to build some saving for your retirement, if you want to generate additional revenues, what we call income backup, then the MAX is certainly a trading system you can apply. And the MAX has been developed many years ago by Dr. James, or we call him Jim Pruitt, called Tiger. Tiger was his nickname due to the fact that he had a very strong temperament, and being growled by the tiger was, believe me, a very amazing experience. So, and I have had the possibility over years, after I became the MAX instructor, to bring some improvement in this trading system. But what the MAX means? The word MAX is in fact an acronym for three concepts. The M stands for momentum. Indeed, when we want to open a trade, we want to be sure that there is enough momentum in the price movement, but not only momentum, but also volatility. The A stands for acceleration. And here, acceleration does not mean that we want to see the price accelerating in the direction we want to trade, but A means accelerating the profits we can extract from the trend we are trading by progressively increasing the size of the position we are handling. And the X of the MAX stands for exit. Along a trade, as I will illustrate in a moment, we will make partial exit and then at some point a final exit, closing the remaining opened position. And so, as I have just mentioned a few words ago, the MAX is essentially a trend following method. But it's also perfectly adequate to trade some breakout situation and some counter-trend situation. And it is associated with a very strict risk management rules. And for the risk management rules, I consider, in fact, two aspects: the trade risk management, how to handle a trade, and the money management, how to handle the growth of the trading account, or how to control the drawdown we are facing sometimes when we have a period with less favorable conditions. And as Craig has mentioned ago, but it's always good to remember, the MAX applies to any time frame and to any market. So what I'm going to explain now, before showing you the power of the MAX, and just to thank you to be present during our presentation today, I would like to teach you 3 trading tips that you can apply immediately in your actual trading system, and these 3 tips will improve your trading result. And so pay attention to what I'm going to explain, because if you apply them, believe me, you will see a difference in your trading. And after that, I will explain the MAX and illustrate these concepts with some charts, with some example recent trades. And so the 3 tips I'm going to teach you now concern the divergence, how we can consider the divergence, the long bar lookout, and the risk reduction. And for that, I will illustrate these concepts on some charts. Consider here a pair we are trading downward, so we consider short trades. The way we define the direction to trade for the moment is not important, but let's suppose at some point that we have opened a trade for some reason. So we have a short entry here at this level with an initial stop loss. ESL in our jargon means emergency stop loss. The aim of the emergency stop loss is to protect our trading account, not necessarily the trade, but also the trading account in the case everything goes wrong and we are not able to make some intervention. So let's consider we have made a short entry, and then at some point we can say that the price is making two lower lows, but on the contrary, an oscillator, a momentum oscillator, and for the momentum oscillator we are using here the stochastic of the RSI. So the stochastic of the RSI we call StoRSI is making higher lows. And so we have a diverging behavior between the lows, the successive lows of the price and the successive lows of the oscillator. Lower lows in the price, higher lows in the indicator. This is what we call, in fact, an exit setup. At the close of this blue bar here, the divergence is confirmed in the StoRSI, and then once the divergence is confirmed, you don't need necessarily to make an immediate exit. What you can do is you can define an exit level following some rules. So, for example, 1, 2, 3 pips above the close of the previous candle or the open of the next candle, then you define an exit level, and if the price follows through and hits that level, then you make a partial exit. Now, making a partial exit in our jargon terminology is called an MX, a momentum exit. Momentum exit because it is based on a momentum oscillator. And when we say partial, it's because we do not close the entire trade. We close a portion of our trade. For example, half of the trade size. In such a way to keep, first of all, to keep half of the trade running, in such a way the price continue to move in favor of the trade, we can increase the profit, but also to bank some profit if the level where we make our partial exit is favorable compared to our entry level. So in this case, lower than our entry level. So in this case, we make a partial exit, for example, here, banking 13 pips, and at the same time, we can tighten our stop loss. So an exit, in fact, with such kind of technical exit or technical analysis exit setup provides the way to bank some profit. Banking a profit helps to reduce the risk we have on the trade. And so this is why a partial exit is so important, risk reduction. And another way to reduce the risk is to tighten the stop loss until a moment when the entire remaining position will be risk-free. In this case, for example, if we reduce the stop loss by, let's say, 10 pips, and we have made a profit of 13 pips, this means that we still have a risk of 12 pips on the second portion of the trade, 12 pips, but because we have made a 13 pips profit, so the global position will be profitable by just 1 pip. At that point, the trade is risk-free. And whenever we can either reduce the risk or bank more profit, we will lock more profit. Later, after some pullbacks, the price makes again successive lower lows in the price, but again higher lows in the StoRSI. We have another divergence, and we can make another, following the same rule, we can make another partial exit. When we say a partial exit, we can close half of the trade, we can close 1/3 of the trade, we can close 1/4 of the trade. It's up to you in your trading approach to define what is the portion of the trade you want to close. And later on, for example, again, we have 2 lower lows in the price, but 2 higher lows in the StoRSI, calling for another exit, which can be, for example, in this case, a full exit. And so that way, the way we use such kind of divergence or helps when the price moves in our favor to bank some profit, and when the price moves against us, this will help to reduce the risk we have on the position. Now, of course, you all know what a divergence is, but what we do in our MAX courses is we define precisely what kind of divergence we can consider. We have 4 types of divergence with extremely clear and defined rules to pinpoint them. We don't consider any type of divergence. We need to define them exactly in order to make our exit setup as automated as possible. And so in this example, we have an example of 37 pips which have been collected along the 3 partial exits and representing, based on the fact that our initial stop loss is 22 pips, a reward to risk ratio of 1.02R. So the profit is 1-2 times the risk we take on the trade. We use the Von Tarp notation. So instead of using, for example, plus 1.02 to 1, we replace the 2-1 by R, which represents the risk we take on the trade. And the risk can be an amount of money, for example, $100, or it can be a percentage of the trading account. But I will come back to that later. So this is an example on how, with a momentum oscillator, we can bank some profit or reduce the risk on the position. And so reducing the risk is an important step toward the trading process, because when we achieve a position when the position is risk-free, and because trading is a psychological game, so we can feel much more comfortable staying in the trade as much as possible. This is an example with a long trade. In the short trade, we were comparing the lows of the price with the lows of the Stochastic RSI. In a long trade, we will compare, on the contrary, the highs of the price with the highs of the oscillator. And in this example, after a long entry, the price makes 2 successive higher highs. The Stochastic RSI makes 2 successive corresponding lower highs, and so we have again a divergence, which was a valid divergence. And so we can similarly define, after the setup bar confirms the divergence, so when it closes, we define our exit level, and if the price follows through, we can take a partial exit. For example, here catching a 49 pips profit. Later on, we have again 2 higher highs in the price corresponding to 2 lower highs in the Stochastic RSI, giving another partial exit. And then later, with another higher high, we can, for example, make a final full exit. And you can see each exit in this very nice uptrend catches a nice bunch of pips, giving a very nice reward to risk ratio of plus 4.43R. A second tip in order to catch some profit is also the technique known, and we teach it much more in detail in the Max courses, the long bar rule. What is a long bar? If we consider this up movement, in which we have taken a long trade with this long entry, at some point we have a long bar. The definition of a long bar is the length of the bar, and the length is measured from the high to the low of the bar, so we include the shadows of the bar, the wick and the tail. So the length of the bar is 2 times or more larger than the average length of the previous candles. We have specific rules to define what we mean by the previous candles, but most of the time, I will say in 90-95, if not more, of the cases, you will be able to eyeball that a candle is a long bar. And so the advantage of having a long bar is not only the fact that probably the momentum is increasing, this will depend also on the volume activity along that bar, but very often, approximately 2 out of 3 times, a long bar will be followed by a pullback, and very frequently by a deeper pullback, erasing completely the swing movement containing the long bar. And so 2 out of 3 times is enough to consider that a long bar is a nice opportunity to bank some profit. And the way to bank some profit is to consider an exit level on the following bars in such a way that if the price follows through and hit that level, we take a partial exit. We close partially our trade. How to consider the exit level is very simple. If the length of the bar is, for example, 20 pips, you can consider a potential retracement defining the exit level corresponding to 1/4, 1/3, 1/2 of the bar. It's up to you as a trader, depending on your risk averse, to define what is the potential reversal or pullback you can accept before making your partial exit. For example, personally, I like to use a 1/3 of the length of the bar. So if the length of the bar is, let's say, 21 pips, I will consider a retracement of 7 pips to make a partial exit. Of course, if the price does not follow through, we will make no exit. So it's not because we have an exit rule triggering that we have to make an exit. We wait for the setup bar, the exit setup bar, to trigger following the rules of our exit techniques, and then we define an exit level, and it's only when the price hits that level that we make our momentum exit. Later on, we have here another second long bar providing also another partial exit or total exit, depending how we handle the trade. Note that in this example, later in the trade, we have also divergences appearing. And so we can combine several types of exit technique. And in fact, this is what we teach in our MAX courses. We will have a certain number of exit technique at our disposal. And after each bar, we will have to check if one or several of our exit technique will trigger or not. And so, as I have already explained with the previous exit technique, whenever we bank a profit with an exit technique, we not only bank a profit, but we also reduce the risk we have on the trade, and sometimes, and very often, we set our trade in a risk-free situation. And this is especially the case with long bar. With a long bar, as soon as we have made a partial exit and we have possibly adjusted our stop loss, the trade most of the time will be risk-free and even guaranteeing some profit until the trade is closed. So controlling the risk, so reducing the risk, is an important aspect to become consistently profitable, but having also clear exit technique will help not only to bank a profit but also to reduce the risk. Of course, we cannot prevent losing trade. We will have always some losing trades. With the MAX, we have a winning rate of around 70 to 75% and around 20% of losing trade. 20% of losing trade, so is very small compared to the 70 to 75% of winning trade. And we can even improve that winning rate with another very important concept I will explain so in a moment. And so I really advise you to watch carefully or rewatch carefully this portion of the video. The video will be available to each participant or to everyone who has enrolled to this webinar. So Craig will send you the link to download the video. And so rewatch carefully this section and test these two exit technique and the stop loss adjustment in order to reduce the risk, to control the risk, and you will see that this will be extremely useful even in your own trading system. Now, what is the MAX, in fact? And so in order to explain the concept of the MAX, I think it's better to illustrate on some recent trades examples. And so the first example is an example of a trade made a few days ago. And you can see that, in fact, on the chart we have, on the main chart, we have some indicators. I'm not showing here all the indicators we are using. I'm showing the most important indicator. But you can see in blue aqua a long-term moving average, which corresponds to a very classical long-term moving average, 200 moving average. In fact, we don't use exactly a 200, but a 233. And this moving average is surrounded by an upper band and a lower band. And the two bands define what we call the home base channel. Sorry, it is called the home base channel. And this home base channel will play an important role in the progress of the price, because we observe that very, very often that home base and home base channel will provide some support or some resistance to the underlying movement. And the reason is due to the fact that many traders, even professional traders, are using such kind of long-term moving average. A smaller moving average is this gold line, which is called the MO line or the momentum line, which is close to the price action. and which will help to define some specific market conditions when we will be in a trade. And then we have a very special combination of two lines, a yellow one and an orange one. And these two lines are called our ETF lines indicator, which are very, very close to the price action itself. And you can see that they are extremely regular. Even in a portion of the price movement when there are some pullbacks, these two lines stays nicely separated, almost parallel. So they are not influenced a lot by the pullbacks. Of course, if the pullbacks becomes important, the ETF line will adjust correspondingly. But the main point is, first of all, they are extremely regular when the price is nicely trending, and then they reverse very close to the low or the high of the price. They do not lag too much. The maximum lag is around 3 to 5 bars, rarely more, often less. And the small down or up white arrows represent when these two ETF lines are crossing, because they will represent an important criteria, not to open or to close a trade, but to validate the potential trade. We want to have the two ETF lines in agreement when we want to open a trade. Then we have also, so as I have already mentioned previously, the Stochastic oscillator, which is a momentum oscillator, which is used not only to validate some of our entries, but mainly used to define some of our exit techniques. So we have lots of exit techniques with the Stochastic. The divergence is just one of the techniques we are using with the Stochastic. And then we have the companion indicator, Craig has mentioned in his introduction. The companion indicator is a very important one. It is made of two lines, one line in red and green, and one line in blue and orange or brown. I never remember what is the color, but I think it's orange. And so the green and red line is called the slow bias, and the other line is called the fast bias. Now, when we want to trade in a certain direction, we want to have the slow bias in agreement. And so we will consider short trades when the slow bias will be red, and we will consider long trade when the slow bias will be green. And so in this example, we can see that this trade was completely in agreement with our slow bias. The fast bias will be used either to validate some entry or sometimes to identify the possibility for a trend to reverse. The change in color in the slow bias will surely indicate that the trend is possibly reversing, but sometimes we can anticipate a reversal in the trend with the fast bias. Now, we have two levels of systems with the max. We have what we call the max primer, and we have the max standard. The max primer is a simplified version of the max standard, and you will see that later why. And the concept of the max primer is to have an entry setup followed by possibly an exit setup and then a final exit before the possibility to open a second trade. I will describe in detail so in this example. But we have some terminology we have to use. So here, when we have an entry, it was a short entry in agreement with the slow bias. We define an emergency stop loss. We have specific rules to define where to place our stop loss and what the size of the stop loss should be. And then in this example, it happened that almost immediately after the entry, which is indicated by this slow angled white line, we had an exit setup triggering, forcing us to consider closing here to make a partial close of the trade. In the max, when I say a partial exit or a partial close, we mean half of the size trade. So this means that we can consider whenever we make an entry that the trade is made of 2 units, and when we have to do an MX, we will close 1 unit. In the course, we explained in detail how to calculate the size of these units. And for that, we use the concept of the position sizing in order to control not only the risk we take on each trade, the financial risk, but also to control the drawdown if we are facing losing streaks. So here, immediately after the entry, we are forced to make an exit, closing one unit with a small loss. For example, here, -1 pip. Later on, the next exit setup triggering is on this red candle, forcing us to consider closing the second unit along this blue candle. What is the exit technique here? It is not a traditional exit technique we have with the MAX, but as an option to the MAX, we can add on the chart what we call MAX price levels. These horizontal lines represent possible supply and demand level. And you can see in this example that this red candle has closed in the proximity of this horizontal white line, which is a possible demand level, and then the price began to retrace. When the price makes a pullback, we never know how deep the pullback can be. And it can be also the beginning of a trend reversal. So we are at a risk here. And so this is why we consider the rejection of a max price level as an exit situation. And so we close the second unit, catching 15 pips of profit. When we consider the entire trade, the result of that trade has been, in fact, no, it is not 17 pips, it is a typo here, but it is 15 minus 1, so 14 pips. I have typed 7 instead of 4 because the 7 on my keyboard is just above the 4. So it's 17 pips representing a result of 0.43 R for the rework to risk ratio. But the trend is not over because we are still in the context of a downtrend. And a few bars later, we had an opportunity to open a second trade with its own stop loss. And then we follow the same rules. So we have here again a max price level rejection. Here we had another exit setup due to the fact that the Stochn RSI has given an exit setup. It is not illustrated on the chart, but we had a divergence here, forcing us to close the first unit with another loss, minus 6 pips, which compared to the stop loss of 18 pips is a small loss. And later, with this max price level rejection, we had the opportunity to close the second unit with a profit of only 8 pips. So with this trade number 2, we are virtually break-even. I consider such a result with a small rework to risk ratio as virtually being break-even. But later on, we had the opportunity to open a third trade and then even a fourth trade with the same concept. And so along a trend with the Max ETF primer during the same day, we may open several trades. And you can see that in this example, we had the opportunity to open just 4 trades, and it happened that the 4 trades have been all profitable for a total of 46 pips and a total rework to risk ratio of 1.27 R, or total result of 1.27 R. Now, if you consider that your risk is, for example, 2% of your trading account, this means that this series of trades have produced a result of 2% times 1.27 or 2.54% of profit. 2.5% of profit on the trading account in just 4 trades in just one day, it's already a nice result. But with the max standard, we can do way, way better. Remind that number of 1.27 R. Now let's consider the same movement, the same trade, but now with the max standard. And with the max standard, one of the main concepts of the max standard is that along a trend, and when I say we want to trade a trend, we want to catch in just one single trade a maximum portion of the entire trend. And we want also, if the conditions are successful or adequate, we want to progressively increase our trade position by making some scaling. And so here, I'm going to explain the scaling process. We have the same entry level as in the max primer. And of course, we have the same first exit setup, so producing a loss of 1 pips on the first unit of the first entry. But later on, all the conditions were fulfilled to make a scaling. We have a very strict rule to make scalings. So we have specific entry setup for the scaling, but we have also to consider the trade risk management. We will skip any scaling introducing an unnecessary risk to our new potential position. The scaling will be made only if the risk is acceptable, and we have strict rules to do that in such a way that the new position, which corresponds now to 3 open units, will be a safe position. And then you can recognize here that in the previous example I have an exit setup, so we will make an MX closing the second unit of our first entry, but we still have the 2 units of our scaling. Later on, we have another criteria here allowing us to make another scaling, and so this scaling will be the third entry, adding 2 more units to our position. So now we are left with 4 open units, which is followed by the same exit technique as I have described previously. So we close 1 unit with a profit, which unit we will close the first unit of the first scaling, the entry number 2. And then we make another partial exit here, closing the second unit of the entry number 2. So we are left with the 2 units of the entry number 3. But later on we had an opportunity to make another scaling, a 4th entry, adding 2 units on our position, followed by another MX, then another scaling, then another MX, then another MX here, then a scaling, an MX here, another MX here, and finally, following some very specific conditions, so we have our x-axis. In this case, the x-axis represents the final exit. We have made 6 entries representing 12 units. We have made 9 partial exits. So when we had to close our remaining open unit, we were left with 3 open units. And you see the result of the 3 units, so 38 pips for the last unit of the entry number 5, and 2 times 9 pips for the 2 units of the scaling number 6 here. Now, you can see that that exit is very close to the lowest low of the day. It's really almost impossible to catch the highest high and the lowest low of a specific day, but we are very close to it. And the reason for this clear final exit was the fact that, first of all, the trend was reversing. Remember, I have explained that the slow bias, the change in the slow bias, but also the behavior of the fast bias helps to pinpoint when the trend is reversing. But we had another very important criteria. You see here this vertical red line. This vertical red line represents a news release. There was a news release at that time, and we have very strict rules when we are facing a news release, especially when we are trading with the macro. We never stay in a trade, except with some more advanced concept. We never stay in a trade when facing a news release. We close the trade 15 to 30 minutes before the news release. And this was a very important, very major, essential reason why to close the remaining open unit. And when we count all the profits, all the results we have made along that trade, so that trade has made a total of 285 pips. But of course, 285 pips seems an impressive movement, an impressive profit. But how much money do we make with these 285 pips? So we have to calculate the result in terms of reward to risk ratio. We get in this example a reward to risk ratio of 7.13, which multiplied by the risk gives us a result of 7.13R. With a risk of 1%, this trade represents a profit of 7.13%, but with a risk of 2%, this represents more than 14% profit. And you can compare that result with the result of the corresponding max primer trade. The result is more than 3 times larger than the result of the max primer. In the max standard, we have made just 1 trade with several scale-in, several scale-out. The MX can be called also scale-out. In the max primer, remember, we have made 4 separate trades. Okay? So here, we have multiplied through the scaling process the result by a factor of almost 5. It will not always be the case. Sometimes the profit, the increased profit will be small, only perhaps 30 or 50% compared to the max primer result, but sometimes it will be 3 times or even larger. And so, as I have explained, what are the concepts used here in the max? We trade the trend, so we have to identify the trend. For that, on the technical point of view, the slow bias and the fast bias will help us to pinpoint what is the trend to trade, and then along the trend we will have entry setups which will correspond to some specific price patterns, and we will have exit setup corresponding either to exit setup given by indicators or exit setup given by the price action, remember the long bar rule, or a combination of both, or even some specific criteria related, for example, to the news release, what I call the critical time period. When we day trade, there will be some times along the day we will have to pay attention. There are the news release, but there are also other criteria we explain clearly and in details in our course. As an optional concept, we can use so these max price levels, which define possible level of supply or demand, or levels of resistance. They are not available for all the pairs. We provide them for free for 4 pairs, but we provide them for many pairs and other instruments based on a small monthly subscription. We have also another option we can use. It's what we call the max advantage or the max bias advantage. The max bias advantage tells us in which direction for each pair we have to favor our trade based on macroeconomic and fundamental and market sentiment analysis, what we call the global context, so which take into account what the central banks are doing in terms of interest rate policy, in terms of daily operations. We take into account the geopoliticals, what is happening between different countries. A typical example has been, it is still the case, the Brexit. We are living the coronavirus situation, which is a very important geopolitical event, but there are other events we have to take into account. We have also the news release we have to analyze, and then the market risk sentiment is the market, the specific market we are trading risk on or risk off. And so when we consider all these points of the global context, we know for each pair in which direction we have to trade. And it happened that in this case, we had to favor the short side of the trade. And this is why when we have a bias telling us that we have to trade in one direction, for example, short, then we can use the technical analysis companion indicator to define or to time when to make our trade, when to make our entries, and when to make our exit. So we want both to be in agreement. And so in this case, because the global context bias is still short, we will ignore this trend reversal. We will not take the corresponding long trade because most of the time that movement will be short-lived. It will not be a trend we like to trade with the max. We like to trade what we call true trends, which are ample movement of more than 50 to 60 pips. So these are the main concepts we are using in the max, and of course I could illustrate the max with a lot of examples in this PDF, and I think the PDF is available to all those of you who want to access it, so I can show several examples. So in this example we have again a short movement on another pair illustrating 2 trades with a total result of 2.71 R, but the same movement made with the max ETF primer or the max primer. Now, if we consider the same movement so with the max standard, we increase the profit by almost 3 times, so 7.6 R instead of 2.7 R. But this was another example of a short trade. Of course, we can trade long with the example of the pound CAD. With the max primer, we had just 1 trade, a very small trade with a +1 R, still an interesting result. But the same movement with the max standard gives again a 7.3 R. Now, it happened that the 3 examples I have just shown exhibit a result of around 7 R, but of course, believe me, the result may be variable from pair to pair and from day to day. Sometimes we will have a result of 5 R's or more. Sometimes we will have a result of 10 R's, so the results are not fixed in advance. We do not fix a target profit. We want to exploit the largest possible portion of the trend, and we stay in the trade and in the trend as long as the trend is still valid. And so we have rules to pinpoint when the trend is possibly exhausting or possibly reversing. I have illustrated the example with the Forex pair, but we can trade also other instruments. This is an example with the S&P 500. For those of you who like to trade the future, the ES contract, for example, you can base your analysis with the MetaTrader platform we are using, and then make your trade on your NinjaTrader platform, for example. But we have also the max on NinjaTrader. By the way, Chris will explain that in a moment. So this was an example of this down movement on the S&P 500, giving just one trade with the ETF primer. And moreover, the time frame I have used is the daily time frame. In all the previous examples, I have used the 5-minute time frame, but we can use any time frame. This is an example of the daily time frame. So a nice 1.49 hour for our result, but with the standard level. So the same movement starting way earlier, so around this position here, we have had 1, 2, 3 entries, so not a lot of entries, several partial exit, 1, 2, 3, 4, and then a final exit in this area when the trend has reversed. And so the entire movement with all these entries and exit has got a total result of 2,560 points, not pips, but points in this case, representing a total result of plus 10.67 R. Consider a 2% risk profit. This trade alone, who has been held for just a few days, has produced a more than 20% profit in just one trade, in just a few days. So, with what you have seen in terms of example, so you may understand that the Max course provides, in fact, trading methods, and I like to use methods as a plural name because we can consider that each entry setups we are using consists in one single trading system. But we have, in order to increase the possibility to have a trade, or in order to trade many more opportunities, so we have several entry setups at the beginning of a new trend or later in the middle of the trend. And the Max, in fact, provides or is based on concept that really works, because they are based, for many of them, on behavior used by the big boys. And by big boys, I mean the traders in the big banks and the traders in the big institutions, for example, the big hedge funds, who are the traders who move the market, who created the trends in the market. And in the course, we explain why these concepts are working and what is the behavior of the big boys behind these concepts. But the course provides also training. Each course is made of a certain number of sessions. We will have a little more information just in a moment ago, and a lot of support in order to reinforce your trading skills, to improve your trading skills in a progressive way, and to make sure that the money management also is a very important aspect in any trading system. In fact, I consider that every trading system is based on 3 essential pillars. The global context, which tells us in which direction we have to trade and why, the technical aspect which helps to time our entries and exit, and the trade risk management and money management who help us to control the financial risk per trade, but also how to control the growth of the trading account and how to control the drawdown. So, because controlling the drawdown is also an important aspect to grow the trading account in a very comfortable way. Because remember, trading is also a psychological game. In order to help our trader to better understand the global context, without necessarily forcing them to make the analysis of the global context by themselves, so we provide a lot of information for free. First of all, we define what are the geopolitical contexts we have to pay attention. Typical recent examples are the following. Of course, the world is still under the influence of the coronavirus with the COVID-19, so we have to pay attention how the epidemic is evolving in each of the countries, so even around the world, because this affects surely the economy of all the countries. we have to still check what is happening between USA and China. With a change in the presidency in USA, perhaps something will evolve. So in that context, so we have to pay attention, simply because USA and China are the two most important economies around the world. And so when something affects one or both these economies, they will have a great impact in the economy of the other countries, and so an impact in the market. The Brexit has been another very important example, and so any events around these geopolitical points have to be paid attention in order to see or to understand why a movement is made in such direction or in another direction, on a short term, medium term, or long term. And so we give these information for free. You can just here on our website, so put your name and your email address to be notified when these informations are updated. And then we provide also a simplified economical calendar. You can use any economical calendar you want for X Factory, FX Street, there are a lot of them, but they give too many news releases, in fact, and a lot of them do not impact the market. There are only a few of them which really impact the market in terms of trend trading. And what we do in our news watch list is we specify for each day of the week. So you see here, Monday, there were no news. On Tuesday, only 2 important news. On Wednesday, only 2 important news. We specify what are the news which may possibly impact the market. And I say may because the impact will be present only if the news present a surprise compared to the forecast you can find in any economic calendar. And we label our news in 2 ways, monitor or major. In fact, we have changed the terminology. Instead of using major, we use a small time frame or all time frame in such a way that to have an idea also in which time frame the impact will be. So a major news will impact in case of a big surprise, will impact so the price movement, will create possibly a trend. And a monitor news is simply a news we have just to observe, because if there is a big surprise in a monitor news, this will not create an important movement in the price of the corresponding pair, but we can see an increase in the volatility. And when we have an increase in the volatility, this is when we have to pay much more attention to the trade risk management. After that, we provide also the list. A list we call the top pair list of the best pairs to trade per week. What are the best moving pairs? Because indeed, because we are trend followers, trend traders, we want to see trends in the price movement. If you consider 2 pairs, for example, a pair showing a trend of 100 pips and a pair showing a trend of 40 pips, what is the pair you will choose preferably to trade the trend? Of course, the pair showing a 100 pips trend. And so larger will the trend be, easier it will be to trade that pair. And so we provide every week an updated list of our best moving pairs, and then for the week. And then when we associate these pairs with the news I have shown previously, we can, for each day of the week, from the Monday to the Friday, we can consider what are the best pair we can consider for each day of the week. For example, that week I'm showing on the screen, on the Monday it was better to consider the pound US dollar, the euro US dollar, and the pound yen, possibly the pound Kiwi and the pound Aussie. On Wednesday, it was, on Wednesday, it was the pound US dollar, the euro US dollar, the pound Kiwi, the pound Aussie, and the pound yen, and so on and so on. In such a way to have less pairs to monitor, to observe, but still giving very, very nice opportunities to trade, again, in the case of a surprise in the news release. But when there is not a big surprise in the news release, we may still have nice movement, nice trends, depending how the market has anticipated the news release. And these are things we explain in our MAX courses. So, as an addition, as an option, this is not provided for free in the course. So, as an option, I say under the condition of a small monthly fee, we provide also every day for each pair some indices, some commodities, gold and crude oil, and some bonds, the US Treasury bond, the 10-year Treasury bond, and the Euro bond. So we provide the direction to trade. Green up arrows, 1, 2, or 3 of them represent a long direction, 1, 2, or 3 red arrows, down red arrows represent down movement. So when we have for a specific pair an up green arrow, we have to trade preferably that pair only long. When we have down red arrow, we have to favor the short trade on the corresponding pair. And this is what we provide every day from the Monday to the Thursday. We take Friday off usually. So for day trading only. And there may be a change in the bias, so several times along the day. And for the traders who prefer to trade higher time frame, we provide also the same bias but on a long-term perspective. So for daily time frame or even above the 4-hour time frame, 4-hour time frame and higher. And so we provide also a direction to favor the trade. But the max bias advantage is not free. There is a small monthly subscription to access these information. So with the max, the max provides in fact a confidence in your skills when you master the concept and the rules. But with each max courses, we also provide a lot of mentoring, a lot of homework, a lot of free workshop, and so in order to practice, to regularly practice, but also to ask questions or to eliminate some perhaps some confusion the max trader can have in applying the concept or in applying some rules or in the way to understand them. So we provide today two courses, 2 levels, the Max Primer and then the Max Standard, which is our flagship training. The Max Primer, as I have said previously, is just a simplified version of the Max Standard course, so with less possibilities, but still profitable. And so this is what Chris now will present you. So if you have any questions about what I have presented, feel free to post a question in the question area, and we will be glad to answer your question when Chris will have made his presentation. And so Chris has very important information to give you now, and so I pass the mic to...
Okay, thank you. Hi everybody, I'm Chris. I'm based in New Zealand, which is part of the reason why the sun never sets on the Max. We're splattered all over the world. This is our 72nd set of Max courses. We've been running these since 2008, and we've trained over 2,100 traders so far. Just to give you an idea on sort of our pedigree and our background. So what we're here for, and I'm not going to take that long, is to make money, essentially. That's the bottom line. It depends on what you want to have the money for, but you really need a goal. It's not just, trading is not just about making money, but it's so that you can actually achieve your goals that you want to look for. And especially these days with COVID running around, people losing jobs and lots of income uncertainty, really does pay to have your own backup. So this is what we can help you with here. So the question is, how will you get there? If you're an existing trader and you're just keeping on doing the same old thing, most people, because they don't have sort of like the mentoring or the personal service, carry on with the weak systems and little interaction. But what we have with the Max here is a structured professional system that's got plenty of supervision and interaction with us and provides consistent results as long as you're consistent. So what most traders will find when they're trading is they'll come up against poor price action, tight ranges, sudden large movements, not knowing what direction to trade in. Indicators can be lagging, and a lot of traders have got, they want simple basic charts that give them the minimum information, like moving average crossovers or something like that. Generally those things are really slow by the time they've kicked in, and you'll find that the Max is much, much faster. The way the Max overcomes this is it adapts to the price action. The Max is not a particular system. It has multiple, well, I'm talking primarily about the standard course. The standard has got multiple entry setups, so that it doesn't matter too much what sort of price movement there is. You'll know if you should be in it or should not be, And when a setup occurs, then you can get in knowing that it's reasonably in your favor. The primer course, the lesser of the two, just gives you 1 or 2 entry setups so that you can get into a trend or manage to handle a breakout, but you won't get as many entries and setups as you do with the standard course. The trades with the standard are much, much larger generally than the primer, mainly because we can hold on to the prices longer, and also because of the work that Eusebio has done with the bias indicators at the bottom of the chart and as ETF lines, you can be more relaxed about staying in a movement when it pulls back against you. When you do the training, you'll be taught several things. Our setups are very precise, and we have a whole pile of steps that you go through in order to validate a setup. Once the setup fires off, whether it's an entry setup or an exit setup, you're on an M5 5-minute time frame. Typically, you'll be in the trade within half a pip of the trade actually moving in your favor. Okay, so when you do the training, the course itself, depending on which course you get, both of them are complete courses. So the primer is complete, it is profitable, but nowhere near as profitable as the standard. But in each of the courses you get all the indicators and the templates, examples, videos that you need, and you'll be invited to the scrolling parties afterwards. You'll also be invited to our Max Trading Forum as well, where we keep some videos and indicators and stuff like that. Not many people are actually posting their charts there, but seems that other platforms have sort of taken that over. We'll give you professional training and precise and detailed setups, very detailed. Like I said, with the homework, and if you ask any questions through the course, you'll get bar by bar explanations of what's actually happening. You have lifetime access to all the materials. We've been through all this, and you'll be with the Newswatch. We want to help you, so we can also supply you with what we consider the best pairs to trade based on the last 4 weeks worth of movement, which news to avoid that's coming up, and if you want, you can subscribe to price levels as well. So you get 4 price levels that Eusebio produces each week to give you an idea on where price is likely to go to or stall at. And all our training is done on MetaTrader, which is a free platform. Most brokers have it, and the data feed is free as well. But unless you're on a really good solid foundation, like all your indicators are lined up, you don't have any counter entry indications, your news releases are pointing in your right direction, and the general global conditions, your fundamentals are rock solid, that's when you can make the best trades. But if you're just jumping into a trade because the technicals have set up, because the moving averages have crossed or something silly like that, that doesn't necessarily guarantee that you've got a really good edge in your advantage. What we do is we want everything lined up so that when we get in, everything is solid behind us, and we kind of sit on a geyser of profit as opposed to just trying things out every now and then willy-nilly. So, and with the in the standard, when you're able to safely add to your trade as well, it's just getting into it, you can really boost your profits, as you've seen from the charts that Eusebio went through. Okay, and on the exit side of things, we have conditions to make absolutely sure that you're getting out when the market starts looking a bit dodgy. So we've got pure technical and price action and a mishmash, a hybrid of those conditions to fire off exit conditions. And then we have exits based on market timing, like if there's a news coming up, we'll get out of it, because in some situations there's going to be lots of volatility when the news comes out, so that's a risk to your account. You don't want to be in there. When the trend actually reverses, again, this is Eusebio's developments showing you that price is looking like it's going to go in the opposite direction, so we get out when there's a trend reversal, and especially at movement exhaustions. So what we want you to end up with is a way of making money for yourself so that you can hit all your goals. So with this, you're going to get a really powerful and safe trading method, And you can use this with other systems. So if you're a break-even trader now with whatever you're doing, when you start using the scaling in techniques with the standard, they can complement your existing system. So a lot of people made a bit of money, I lost money, and just carry on like that. When you start becoming, can scale in and can get out at good points, not letting things slide back too far, then you become more confident, and so you start making more money, and so you become more confident, so you start making more money. So once you start scaling in and start doing the standard side of things, then it really does boost your profit results. The system itself has got a win-loss rate of about 65 to 85%. Depends on which time frame and which pair and what the market's doing at that particular point in time. But if you're using, say, a higher time frame like the H4s, the win rate goes up to over 90%. And what we've got today are two courses, the Max Standard and the Max Primer. The Max Standard is our flagship course. It's called Standard because it's the regular one. It runs for 7 sessions. It's got multiple entry scenarios, I think about 11. So that means that it doesn't matter what situation the market's in, you can pretty much find a way of entering into it. We've got the profit acceleration side of things, that's the scale-ins or reverse pyramiding, if people are into that, and the trade and risk management. It's very natural. It's easy to use while you're doing. You don't have to do any complex calculations or any calculations at all. It just fits with your trading as you're going. So it's very nice to get into. And once you've started scaling in, you become much more relaxed when you're trading. Once you start becoming in profit, and when you're in profit, you can become a lot more relaxed about entering situations because you know that you're going to start making some nice profits. Max Primer only runs for 2 sessions. It gives you a couple of entries and about 3 or 4 different exits. So it's not as comprehensive as the standard. It's just there to give you a taste of what we are like if you wanted to try us out first. It is profitable, but minimally profitable compared to the standard. About as profitable as the regular system. And the risk management is, well, it still protects you, but it doesn't have the all the bells and whistles that the standard has. So the standard course begins in a couple of weeks on February the 11th, runs for 7 weeks. Normal price is $2,999, and we've got a webinar special for $2,399. So if you want to take it, that's the one to go for. That's got all the bells and whistles. And the primer course also begins on the 11th. We run them concurrently because the first 2 sessions are the primer course part of the standard, and then the standard just carries on afterwards. Normal price is $329, and the webinar special is $159. So if you really wanted to, you could start off with the primer and then upgrade to the standard once you get an idea on what the course is like. Both of them have videos and everything that you need. There's no extra costs. So let's just flick through the questions that have come up in the chat group. Ray has asked, is this software trading price action or trading price action? I'm not too sure how it's supposed to be done, but Eusebio, can you answer that one? Price action.
Yeah, in fact, it's a combination of price action, indicators, and fundamental. So fundamental helps to define in which direction we have to trade. Technical analysis and price action analysis help us to define where we can enter, where we can open a trade, and where we have to consider our different types of exit. We have, for example, exit technique based on indicators, based on price action, based on a combination of price action and indicators, based on critical time period, based on exhaustion or reversal of the trend. So we have sets of different types of exit techniques, and price action is just one of them.
Ken has asked, so the max is a technical strategy and not a fundamental. I'll leave you to answer that one, Eusebio.
No, the max is not especially dedicated to fundamentals. It is essentially dedicated to technical analysis, but we include fundamental analysis and more globally what I call the global context analysis in order to understand why a specific movement is unfolding and how and why we should trade that movement instead of the other movement. So, and this is why we provide a lot of information. Analyzing the global context is a huge task. It takes me every day minimum 1 hour before my trading session to analyze the global context. And so we provide lots of information for free. For example, what I have shown with our Newsmax news watch list page. We provide a simplified economic calendar. We provide the pairs to prefer to trade. So a large portion of the global context is already done, and through our subscription service with the global context bias or the max bias advantage, so we give the exact direction based on that context analysis to favor. But every trader can make the global context analysis by himself or herself, taking into account what we change into the max.
Okay, thanks, Eusebio. The question from Lee was, is the 5-minute time frame the one that's most used on pairs?
Yeah, in fact, generally speaking, there is no one best time frame. The best time frame you can trade is the time frame which best suits your own constraint. Because you may have a job, a 9-to-5 job, and so depending on your responsibility, depending on your constraint, there will be always one time frame which will be the best for you. And so you have to practice several of them to find the one which fits your own constraints. But it's true that on a mathematical point of view, smaller is the time frame, more opportunity you will have, and better the profit will be if you master your trading process.
Okay. Do we have a daily trading room?
No, we don't have a trading room for the same reason I have explained with the track record due to the regulation limitation we have here. I live unfortunately in European Union and in France especially, and we have very strict rule for that. So,
this one's for you, Eusebio. How can one minimize losses in trading besides stop loss, as it seems the market makers hunts for these?
Yeah, indeed, the markets sometimes hunt the stop loss. This is a normal mechanism. It may be also due to some manipulation made by the big boys, simply because the big boys, it's not that the big boys are necessarily looking for your specific money, but because they need good entry levels, and they want on all their entry levels to have a good entry level for their entry and a good exit level for their exits. And so how we can minimize, in fact, you have to figure out, let me try to take an example. Let's take this one here. We have, for example, an entry here. Okay, we have an entry. And usually what many traders will do, they will place their stop loss for a short trade above the previous swing high. We have another high, so here. So they will set their stop loss in this area. With a big simplification, in a downtrend, whenever we have a high, we may have some liquidities located at that level because there are places for stop loss or possibly entry levels in the opposite direction. And so most of the liquidity will be here. And in order to avoid being stopped out at that level, we can take, for example, the previous high. Or when we have, like in this example, several levels of supply and demand, you can see my stop loss was above that area of supply and demand levels, in such a way that if the price makes a spike, we will most of the time avoid the stop loss to be hit. And so you have to analyze carefully. There is no strict rule, there is no mechanical rule telling that. You have to analyze carefully your chart, knowing that most of the time the stop loss will be on the previous swing high or on the previous swing low when we look for a long trade. And so you have to avoid that area. And so don't hesitate to take a larger stop loss. If you take a larger stop loss, you will have to decrease your trade size in order to keep a good control on your trade risk, on the potential loss, financial loss you can make in your trade. This is really essential in handling your trade.
Okay, thanks. And that's it from Ken on the questions. So let's wrap the session up here, you say?
There was still one question by Mihailo.
Oh,
how do you determine the global context? Yeah.
Okay.
There is not a mechanical way to determine the global context because several driver may trigger a price movement. Let me just give you an example. Let's suppose that we are, let's say it is the euro-yen. Let's say we are on the euro-yen here, okay? And so let's suppose that we are here at the end of the day, on this point. Let me try if I can take the pen here, and I will change the color. So let's suppose we are in this area at this moment. And at this moment, the Bank of Japan decides to increase its interest rates, so the interest rates on the yen. What will be the effect in the market? Generally, many traders will consider that the yen should strengthen, because usually an increase in the interest rates induces a strengthening in the currency. Okay? But here we can see that sometimes the price can move against the currency. In this up movement, the currency, the yen, is weakening. Why that happen? This happens because, in fact, the market has already anticipated that the Bank of Japan would increase its interest rate, and this is the reason of this downtrend. Now, this is not the real reason in this example, it is just to illustrate. So if the market has already anticipated the decision of the central bank, they will move the market before the announcement. And when the announcement is made, it's our responsibility as a trader to analyze if there will be still an impact, or if the market will react normally, or if the market, because the anticipation has been perhaps exaggerated, if the market will even reverse in the opposite direction.
We'll wrap this up now and leave it up for a few minutes. I have to prepare for the Newswatch list, which we'll go through with Eusebio and I will go through, put it up on our website, on the Newswatch page on our website. But to everybody that's still in here, thank you very much for coming along. If you have any questions for us, email them and we'll run them through either in the non-farm payroll session coming up this week or in the follow-up to this session the following week, where we'll be answering a whole pile of questions. But thank you very much for coming along. I hope it was worth your while, and look forward to seeing you on a course shortly.
Yeah, bye everyone. I will close the room in exactly 5 minutes, so at 17:10, which is the New York time here. Okay? Thank you very much and see you soon.